So what if everything a central bank did to make its country's currency stronger actually made it weaker? It sounds completely backward, right? But it's a real puzzle that had economists stumped for years. Today, we're going to dig into the paper that finally cracked the case, identifying monetary policy in a small open economy under flexible exchange rates.
Okay, so let's set the stage with that exact puzzle. Imagine a central bank does precisely what the textbook says to do to boost its currency, but the opposite happens. The currency weakens. It feels like it breaks the fundamental rules of economics, doesn't it? Well, that's the mystery we're going to unpack today.
You know, this strange result wasn't just some weird one-time thing. Nope. It was a consistent, baffling contradiction that kept popping up over and over again. So this thing actually has a name, the exchange rate puzzle. Here's how it's supposed to work according to theory. A country raises its interest rates. That makes it more attractive for foreign investors, so money flows in, and poof, the currency gets stronger. Simple. But what was happening in the real world was the complete opposite. Central banks would pull that lever, and the currency would actually get weaker. It just defied all logic. And look, this wasn't just some dusty old theory in a textbook. This was happening in the real world, in small, open economies like Canada that depend heavily on trade. Policymakers were doing the right thing, but the machine was going in reverse. It had economists everywhere just scratching their heads, wondering if they had it all wrong.
So what gives? Were the textbooks just flat out wrong, or was there something else going on? Well, as we're about to see, the problem wasn't the economy itself, it was the tools people were using to look at it.
To really get this, you have to understand that not all economies are created equal. On one hand, you've got these absolute giants, like the United States. Think of them like giant fortresses. They're less affected by what's happening outside their walls. Their central bank can pretty much focus on what's happening at home. But then you've got smaller, open economies, like Canada. They're more like glass houses, incredibly sensitive to every little thing that happens globally, especially with their neighbors. And right there, that was the crucial mistake. Economists were taking a model built for the fortress, the US, and trying to apply it to the glass house, Canada. It was a classic case of using the wrong tool for the job. You know, like trying to turn a screw with a hammer. It's just never going to work. And you can literally see the problem right here in the data. This graph is what you get when you use that old mismatch model. Just focus on the chart in the bottom right. When the model tries to show what happens after Canada raises interest rates, that line for the exchange rate goes down. That means the Canadian dollar is getting weaker. This is the puzzle. Right there on the screen, a total contradiction.
So how do you fix a problem like that? Well, the authors of this paper had a brilliant idea. They decided it was time to model a new reality.
The authors, Cushman and T, they put it perfectly right in their introduction. They said, this paper argues that these puzzles derive from an identification of monetary policy that is inappropriate for such economies. In plain English, what they're saying is, hey, the puzzle isn't out there in the real world. The puzzle is in our models. We're just looking at it all wrong. Their key insight was actually pretty simple, but it was a total game changer. They said, let's just build a model that reflects how the world actually works. Step 1, acknowledge that a small economy is always going to be pushed around by its huge neighbors. Step 2, assume the central bank in that small country is watching things like exchange rates and commodity prices and reacting instantly. And step 3, the most important part, build those real-world reactions right into the DNA of the model. Here's a great way to think about it. Imagine Canada is a small boat bobbing in the water, and right next to it is the United States, a massive aircraft carrier. The old model basically pretended the aircraft carrier wasn't there, totally ignoring the giant wake it creates. The new model, on the other hand, watches that wake like a hawk, because it understands the small boat's movements are completely tied to it.
So, what happens when you finally start paying attention to that massive wake? Well, something pretty amazing happens. The moment you do, the puzzle just disappears. Okay, this right here is the big reveal. On the left, you've got the result from the old model, showing that baffling result where the currency weakens. But look at the right. This is the new, realistic model. After the very same interest rate hike, the exchange rate shoots up immediately, exactly like the textbooks say it should. The puzzle is gone. It was never really there to begin with. So the takeaway here is super clear. Once you use the right tool, all the weirdness just vanishes. So let's take a closer look at what the new model showed us. So check this out. This is the first big result from the new model. After that interest rate hike, the line for the exchange rate immediately goes up, and it stays up. The Canadian dollar gets stronger, just like every economic theory would predict. Boom, problem solved.
And it's not just the currency. The new model also gets the rest of the economy right. This graph shows that overall economic output takes a small, temporary dip right after the rate hike. And that's exactly what you'd expect. Tightening policy is supposed to cool things down a bit. The model is now behaving just like it should.
So, long story short, by just building a model that accepted the reality of how a small, open economy works, the authors finally got a picture that was clear, accurate, and made perfect sense. Case closed.
Okay, so a decades-old academic puzzle gets solved. Big deal, right? Who cares? Well, actually, this is a really big deal, and that brings us to our final and, I think, most important section, why this all matters.
This discovery goes way beyond the classroom. It means we have much better tools for central banks to work with, it leads to more accurate economic forecasting, it allows for smarter, more effective policies for any country that's deeply tied into global trade, and really, it just gives us a clearer picture of how interconnected our world truly is.
When you boil it all down, what this really means is that policymakers in countries like Canada or Australia or Mexico can now navigate the incredibly choppy waters of the global economy with a much, much better map and compass. They're not flying blind anymore with a map that was drawn for some other place. And that leaves us with this one last powerful thought. Sometimes the things that seem like the most confusing problems, they aren't actually problems with reality. They're problems with the way we're looking at reality. It makes you wonder, doesn't it? What other big puzzles are out there just waiting for someone to come along with the right perspective?